Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. And from several last lectures, basically we are discussing over the Banking Regulation Act 1949. Alright, that's what we have covered so far. That's what we are covering now. Okay, and basically in the previous lecture we had discussed in detail like the licensing provisions. Okay, which means that each and every organization involved in the financial or the banking sector must require to obtain the license from the Reserve Bank of India because it is an regulatory authority. Without having the license from the RBI, no entity could allow to do the banking business in India. Okay, and thereafter we have seen so many criteria regarding how the license issued, okay, and how because of the different type of banks the license differs. All right, so I hope that you have revised the previous lecture properly before you have come for this lecture, as it is for your own benefit. All right, so basically in today's we are going to talk about the branch expansion. Now what do you mean by the branch expansion? It is the first thing what we should understand. All right, so this is the question we have to deal with. Okay, but before starting discussion over the branch expansion, my first question is, do you understand what do you mean by the branch? What do you mean by the branch? Okay, so basically, let me give you an example. Suppose if we talk about Canara Bank. So where the Canara Bank established? The Canara Bank was established at Karnataka, right? But if there is a person who is living in Delhi, okay, living in Mumbai, Jaipur, okay, Bhopal, and any other major cities or some minor cities. So is the person available to get a chance to deposit its money in the Canara Bank? Answer is yes. Okay, people who do not living in the Karnataka area, still they may be the customer of the Canara Bank. So how it is possible? It is basically possible because Canara is having its headquartered in the Karnataka, but it's having its regional offices or branches all over India. Okay, so branch is basically, you can say, it is a regional offices. All right, and in a simple definition you can say a branch is a or is an office of bank, particularly designed to expand bank's network and to facilitate customers. Okay, so there are two main reasons. First thing is expanding the bank's network, which means in case of Canara is not having the customers only from the Karnataka, but also having the customers from other states. So it is first like expand the bank's business, and second to facilitate the customers. For suppose, if I am the customer of the Canara Bank, I opened an account in Canara during Karnataka when I was living in Karnataka, but after some time I have moved to the Delhi. Now I am Delhi. Okay, but My account is in Karnataka, and suppose in case the Karnataka do not have any the Canara Bank do not have any regional office in Delhi, then I am able to use the branches. I am able to use the services of the Canara Bank. The answer is no. I have to go to Karnataka from Delhi, then only I can use the services of the Canara Bank. And we know it will be a very, very difficult for customers. Alright, that's why to facilitate the customers, Canara Bank will open a branch in Delhi. Okay, so that those customers of Canara Bank who are living in that area, instead of coming to Karnataka or the head office for every work, they could use the branches. Okay, so now I hope you have got a clear example of the branches. Okay, what do you mean by the branch? Now, let's come to the topic of branch expansion. Alright, so as I have told you, banks are generally designed for two things. First is for their own profit earning, and second for increasing customer base. Okay, so if the bank lies only a particular area, suppose this is a city A, and the bank only having the office or only operation in the city A, and thereafter there is a bank who lies at city B, city C, city D, and so on. So do you think in this scenario whose customer base will be huge? This bank or that bank? Obviously that banks, because they having their customer bases in all over the country or globe, you can say. Okay, that's why. And when they having a more and more customers, they will grant more and more loans, they will run more and more schemes, and their profit will increase. Okay, so this is the provision for the branch expansion. But now we have to understand what are the rules, what are the regulations, what is the criteria behind expanding the branches of the banks all across the country as well as in the foreign countries. Okay, and remember, all of these things is mentioned in Banking Regulation Act 1949. Okay, and which organization ensures that all the provisions of the BRA 1949 are meeting up. So the organization name is Reserve Bank of India, because it was established as a regulatory authority by the BRA Act. Okay, so now I hope that you have got the clear understanding of the branch expansion. Let's move to the provisions. So the first and the foremost provision of branch expansion is RBI approval. The banks are required to obtain the approval of the Reserve Bank of India before opening new branches. This ensures that the RBI can assess the need for a new branch and the bank's capacity to manage it effectively. Okay, so just write down one thing. If there is any bank who want to expand their branch, okay, so it does not mean that the bank could expand the branch by their own. Okay, for example, suppose if this is a bank called XYZ, okay, and this is the owner of the bank called Mr. R. Okay, so Mr. R found that XYZ should be increased or should be expanded. Okay, so he could not open the new branches by his own. Okay, he is required to get the approval from which organization? RBI. The Reserve Bank of India is required to give their approval to facilitate Mr. R to open the branches. Okay, and the approval required so many things. Is the bank properly able to handle the new branch? Is there proper logistic support? Is the branch expansion is in the favor of the customer? Okay, is all the other capital requirements are meeting up or not? Or remember one thing, Mr. R is liable to Reserve Bank of India to explain every possible reason for branch expansion. Okay, why Mr. R now wants to expand their branch? He is required to explain it to the RBI. Then the approval will be granted. Before it, there is no chance that he could directly expand the branch. Okay, so remember, first point, RBI approval is must. Thereafter, the capital adequacy. Before expanding their branch networks, banks must meet the minimum capital requirements as stipulated by the Reserve Bank of India. Sufficient capital is essential to support the operations of new branches and maintain financial stability. Okay, so for example, suppose if there is a bank, again the XYZ, okay, and this is Mr. R, who is the owner of XYZ. Okay, now if we want to expand the branches in several places like city A, like city B, and like city C. Alright, he wants to expand their branches. Now the question is, what should be the minimum capital he must hold while doing it so? Okay, he could not say actually to constructing the buildings, appointing the staffs, getting the approvals, I am bearing a cost of 1 crore rupees in opening of all these branches, so I could open it. No, this is not allowed. Your shifting and operational cost does not indicate your stability. Okay, which means that on the basis of your shifting and operation cost, you could not justify the capital adequacy. Basically, it means minimum capital reserved required at every new branch. Okay, it means that if he is opening the branch in city A, in city B, and in city C, okay, then at every branch, minimum capital reserved required, minimum capital reserve required, minimum capital reserve required. All right, it means MCR or the minimum capital reserve is basically a total capital reserve splitted by the RBI, which is to be present with each and every new branch the bank is opening. Okay, and basically this reserve depends upon types of banks. Okay, it means that the criteria for minimum capital reserve is not same for all the banks. Okay, why? Because there are many types of banks, like some are commercial banks, okay, some are public sector banks. Sorry, public sector banks are the part of the commercial banks. Some are scheduled banks, okay, foreign banks, wholesale banks, and etc. There are many banks and their types, and each and every bank have their specific type of customer. Like the foreign banks generally, or commercial and scheduled banks generally, deals with the individuals or the small scale businesses. But the wholesale banks basically deals with large corporations. All right, deals with the government. They involve the heavy transactions. Okay, so which means because their transaction is heavier than the others, so they require a different capital reserve than these ones. Okay, so remember this point. The reserve or the minimum capital adequacy reserve is basically depends upon the types of bank, which type bank is opening their branch due to their different type of customers. Okay, so basically if we talk about minimum capital reserved, all right, so the first is scheduled commercial bank. Okay, the second one is foreign banks. The third one is private banks. Fourth one is small finance bank. And the fifth one is local area banks. Okay, so if we talk about the minimum capital requirement for all of these banks, then the scheduled commercial bank required rupees 3 billion as the minimum capital reserve. The foreign banks required US dollars 25 million. Okay, the private banks required rupees 3 billion. All right, small finance bank required rupees 2 billion, and the local area banks required rupees 25 crores. Okay, so this is the minimum capital reserve required for scheduled commercial bank, rupees 3 billion, foreign banks 25 million US dollars, private banks 3 billion rupees, small finance banks 2 billion rupees, and the local area banks 25 crores. All right, and here are some important points, or you can say these are the points to be noted. All right, so the first point is that minimum capital reserve is higher in case of domestic banks than foreign banks, as foreign banks required to maintain reserve in their own countries as well. Okay, it's the first case. Second thing which we should note down is that RBI may allow the banks to fulfill MCR or the minimum capital reserve ratio by combination of tier 1 and tier 2 capital. All right, and the third point is that banks required to maintain minimum CER is 10% before expansion of branches. Okay, so these are the three main points which we should note down. The first is minimum capital reserve is higher in case of domestic bank than the foreign banks. So you can say in the case of scheduled commercial banks, it is 3 billion rupees. But in case of foreign banks, it is $25 million. So generally, what we have a perception is that dollars is basically higher than the rupees, which is not wrong. It is correct. But there is one game which we should understand. And this is basically nearly about 21 CR and all is basically the 3 billion in the general calculation. Okay, but 20 crores rupees is basically the 25 million US dollars. And please remember, these are not the accurate values but are the approx values, because I'm not your math teacher. Okay, so remember this thing. All right, so 25 million is for the foreign banks and this is for the Indian banks. So now you can say why the Indian banks have to give more MCR than the foreign banks, because the reason lies here. The foreign banks require to maintain the reserve in their own countries as well. First thing we need to understand is that actually the foreign banks do not belong to India. They belong to some other countries, and by taking the permission from the government of India or the Reserve Bank of India, they are doing the business in India. Okay, but it doesn't mean that their responsibility towards their home country will be dissolved off. Okay, so as they are working in India, they also require to maintain their capital adequacy in their homeland, all right, from where they belong. That's why we generally give less pressure to foreign banks on maintaining the MCR. Remember this thing. Second is RBI may allow to banks to fulfill the combination of MCR by Tier 1 and Tier 2 capital. Now, most of you are not aware about the Tier 1 and the Tier 2 capitals. Okay, but I had told you what you mean by the capital so many times. So let me give you a definition, then I will explain it. It is the main capital using by banks in day-to-day operations and belongs to initial capital and share. All right, whereas the Tier 2 Tier 2 is it's the capital maintained by banks to meet up or survive the losses, and Tier 2 capital is basically confidential in nature. All right, so this is the basic definition of Tier 1 and the Tier 2. Tier 1 is the main capital using by banks in day-to-day operations and belong to the initial capital and the shares. And the Tier 2, it's the capital maintained by the banks to meet up, you can say, meet up and survive the losses, and Tier 2 is basically confidential nature. So let's understand it. Okay, suppose this is the bank called XYZ. Right now, I'm giving you the example of Tier 1 capital. All right, this is a bank called XYZ. So when the XYZ was established, so there are two types of funding. First is the initial capital and second is the shareholding. It is the basic division. All right. So basically, you can say when the bank was established, rupees 50 crores were invested in the bank. Okay. Later on, they required 100 crores further. Okay. So they issue their 10 shares in the market at 10 crores each. All right. And their shares were purchased by the you can say various people in the market. All right. So now by purchasing the shares, when the 10 people gives them rupees 10 crores each, so they got additional rupees 100 crores by issuing the shares. So the total holding they have right now is rupees 150 crores. Okay, and this rupees 150 crores is basically the tier 1 because it is the main you can say the main capital using by the banks, initial capitals and shareholdings, or you can say it is also signifies the deposit is held with the bank. Okay, so this is the main capital and it is in the public domain. Okay, and you could understand it by suppose if you're searching the wealth of any bank, you just type on the Google, tell me the net worth of this bank and this one, this. So whatever the information about the financial status you got the information about the tier 1. Okay, because it is in the public domain. Now suppose the founders of XYZ, after expending the rupees 50 crores in the initial, still they are maintaining rupees 60 crores balance, okay, which they put in the operations of the bank during losses or needs. Okay, so this is called the tier 2 capital, the capital which is generally used to meet up the losses and meeting the need times. All right, and this is also known as supplementary capital, which means 60 crores are not directly put in the operations. Right now they are doing the operations by rupees 150 crores, but suppose the bank losses, bank facing a huge losses, there is something unusual happened with banks. In this scenario, they will put rupees 60 crores in the cycle, which means 150 was initial and the 60 was supplementary capital. So nearly about 210 crores will be the total capital available with the bank to meet up the daily requirements. All right. So this is how the tier 2 and the tier 1 capital could be understood. Now I hope you have got the idea. And remember one point, it is called the primary capital. Reason I have told you, it is directly used in the day-to-day operations, whereas this is called the secondary capital because it is generally not used in the day-to-day operations, but it is maintained to meet up the need of the time. All right, and remember one thing also, as I have told you, this 60 crores, or you can say how much supplementary capital holding by the bank, this report is confidential and generally not available in the public domain. All right, but the RBI could allow the banks to maintain the MCR or the minimum capital ratio by using these both tier 1 and tier 2. For example, suppose the bank is a private sector bank which required rupees 3 crore billion. Sorry, 3 billion. 3 crore billions, it really a huge amount. Okay, rupees 3 billions to open the new branch. Okay, in the tier 1, they having only 1 billion, you can say, not even 2 billion, having only 1 billion. So they are not meeting up the criteria. So they will not allow to participate further. Okay, but as I have told you, the Reserve Bank of India may allow them to use their tier 2 capital also to maintain the basic requirement. And their tier 2 capital, they are having 2 billion additional. They were maintaining it. So now by merging tier 2 and tier 1, now they having rupees 3 billion. Okay. Rupees 3 billion, which states that now they are maintaining the minimum capital reserve. Alright. So now I hope you have got the tier 1 and the tier 2. Alright. Thereafter, another term was 10% CAR, which is to be maintained by the bank. Now here the question is, what do you mean by the CAR? So CAR is basically stands for the capital adequacy ratio. Alright, and what is this? So if we basically look at the definition of CAR, then it is the ratio of tier 1 and tier 2 capital in comparison of weighted risk of the bank. Okay, so generally it is like this: tier 1 plus tier 2 divided by weighted risk. Okay, so in this scenario, tier 1 and tier 2 is basically the total available capital with the bank right now, and weighted risk is basically the liability and the risk the bank is facing right now. All right, so it is generally done to ensure that the bank having sufficient capital to face hardship challenges against weighted risk. All right, that's why it is mandatory that after dividing the tier 1 plus tier 2 by the weighted risk, the ratio must be around 10%. If it is going more, then the bank will declare insufficient to handle the hardship challenges against the risk it had taken, and that's why the banks will not allow to expand their branches. All right, so students, in this lecture we have discussed the several facts about the branch expansion, like the minimum capital reserve and the RBI approval, and what do we mean by the branch expansion and all. In the next lecture, we will continue with the provisions of branch expansions under the Banking Regulation Act 1949. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for another lecture. With this note, let's end this lecture and thank you.